So let's put the latest inflation data for November in our commodities metrics. Well, demand, supply, and price. Those are the three major pillars of any commodities. Nasik Wajide, a member of economic think tank at Financial Derivatives, is live here in the studios at our global headquarters. Good morning. So let's put inflation in all of this, isn't it?
Yes.
It's both demand and supply, then price.
Yes.
So this is as close as the real numbers could get to your forecast of 11.88%. Just three notches.
Just three notches. I mean, everyone expected, or everyone forecasted a rise in inflation. There's obviously the border closures. The impact of that's been there's a rise in the price of staples, and not just staples, but everything that we import or has been smuggled across the borders over the years. There's also the lower interest rate environment, which basically is a disincentive to save, so people spend less. There's been increased liquidity in the markets, not just the money markets or capital markets, but people have been spending the money. So that increased expenditure. There's also talk about some states actually implementing the new minimum wage. So there's people spending more money than they ordinarily would. So increased aggregate demand. So on the supply side, basically, there's typically at this time of the year, there's seasonality comes to effect. There's the harvest season and all of that. There's also increased seasonal demand because it's the festive season. But this year, we've seen that's the typical impact, positive impact we have on inflation from the harvest season completely annulled. So it's increased liquidity, increased demand, and prices have risen. We expect that. I mean, stuff like the border closure between October and November, it was less than the impact between September and October. Because, initially there was the scarcity, but Nigerians or production has risen to a little extent and covering, meeting up some of that deficit. So that's why you see, of course, the year-on-year increase, but the month-to-month increase or month-to-month change has actually declined.
Yes, declined, So in a manner of speaking, if we continue on this trajectory, just assume that the border remains closed for another 3 months, maybe into Q1 2020. What's your take from here? Do you think the market will continue and local production will continue to adjust, or we'll see a runaway inflation level hitting 15% by the end of Q1?
I doubt if we get to 15%. We'll see inflation rise.
I just play the devil's advocate.
Not at a runaway rate of 15%. Local production will continue to rise. People who typically smuggle across will find ways of importing their goods through the ports. I think, like I said, playing the devil's advocate. I mean, prices will rise. We expect prices to rise, not just because of the border closures. There's a minimum wage that would, if we imagine that
more liquidity in the system,
the entire
and where you have more money chasing less production, simple economics,
and productivity hasn't risen to match that increase in.
So that will kick into inflation,
even if you didn't close the borders.
Even if we didn't close the borders, because there's so much liquidity right now, and that brings us to part of your burning economic issues. Is as far as lending rate, treasury bills rate is now going underwater. Inflation is now across. If you look at NTB. Is such a disparity right now. NTB, single digit. This is inflation, solid double digit.
Yes, NTB is single digit. You have all this people who've been barred from the OMO markets basically moving towards TBO. So the prices, the rates have fallen. There's so much liquidity. Real returns on investments are negative. High inflation, low interest rate environment, and that is poised to continue. Like I said earlier, people would right now people are there's a big disincentive to save. So the increased liquidity is doing as much, I wouldn't call it damage, so to speak.
But it's denting.
It's denting.
It's the denting return on investment.
Returns on investment. I mean, even for the talk on pension assets growing by 2.4% October, in the coming months, I mean, as the pension fund administrators have less outlets for their investments, those returns are estimated to drop going forward. So
I think it's a big story for another day when we look at our pension assets rising, and returns this year had been had been down since this rejigging of the treasury bills market by the financial regulator. And all of that will be what everyone who holds a pension asset should, a portfolio should consider moving forward. Okay, let's move on and look at the goodies and the downers. If we try to play it out, I woke up this morning, saw Brent crude at 65.35, and I was still happy that it's still at a very decent price.
Oh yes, obviously. I mean, our benchmark oil price is about $60 a barrel, so that's $5 above the benchmark. We've seen external reserves that have been dropping for quite some time. I mean, this increased forex earnings would go somewhere in pushing up external reserves. But Nigeria is more production sensitive than price sensitive. So this slight increase in price, when you look at production is about last year about 1.77 million barrels a day, which is still over our OPEC quota at the moment. So it's something that's, as OPEC, they reached the deal, they decided to cut output by 500,000 barrels extra last week. We expect that there will be increased enforcement. Member states will be forced to comply, and Nigeria will be forced to lower its output even further. So that might, I mean, whatever you gain in increased price, you would be offset by lower production.
I don't want us to miss this very quickly, the market survey, and that's I want us to take a quick look at that. I look at the price. This is good, guys. Putting your foot on the ground, boots on the ground, and try to get us with the market survey. Where are we? I bring that up in terms of commodities price movement. I just need to check in what I have in store at home and what I may need to cough out some money to buy as we get to that very crunching week. By this time next week, it will be the 24th of December.
Christmas Eve.
So Christmas Eve. This is just an 8-day outlook. Right. Take me through this, please.
Okay. Gary prices have risen slightly. It's not what you would call substantial. It's not like a substantial rise, but they've risen over the past month. Basically, it's like I said, it's harvest season. You expect the increased output to...
Can we just go to rice? That rice is what everybody wants to know. Leave Gary alone. Most of the guys watching TV right now wants to know about rice. So let's just go straight to rice. The price is neuter. Folks are looking for where they're getting the bag of rice.
Rice prices haven't changed in the last month. Like I said, the increased price from the border closures, some local production has gone some way in offsetting the price.
So rice... 50 kg is gone neuter.
Yeah, it hasn't changed in the last month. And you've seen some people moving to alternatives, moving to
local rice.
Local rice. There's people moving to pasta, there's people moving to yam, to potato, other forms of sources of carbohydrates, if you will. And so that has had the effect on the market. So prices haven't changed as ordinarily we expected to. By the
yes,
end of the year,
rice prices haven't really dropped, but it just kind of plateaued.
Just kind of plateaued.
And sticking around there, looking for a breakout, whether something that will bring...
Whether it's increased demand or increased supply. Hopefully Nigerians will produce more rice. Increased supply will push down prices.
And what we have here would be a lower trend. 1 year low, 14,000. I wouldn't mind us getting back to that level. So rice, flour, beans and tomatoes are a little bit tepid as we speak in terms of prices.
Yes, those staples, those things that... were really impacted by the border closures. Yeah, Nigerians have found either alternatives or found a way to produce locally, and that is offsetting the price rises. Prices have plateaued, like you said.
Very interesting. If pepper prices are also going down, that all goes into my dinner table, and that looks very good. Let's check in with the soft commodities market globally. The weather conditions around the world is getting a lot more scary every day. Here in Africa, elsewhere in the world, climate change is the big story and is impacting soft commodities all over the world.
Yes, we take wheat prices, for instance. So, there's expectation of extreme weather conditions early next year, early 2020, and that's already going to markets already factor in that it will affect wheat production, and prices are already rising. There's corn prices, for instance, even grain prices in general, that the de-escalation of the U.S.-China trade spats. Basically, the Chinese are going to buy more U.S. corn, and we've seen prices have risen because of that. For cocoa, benign weather conditions in the big producers, Ghana and the Ivory Coast, seen increased production basically, and that's caused prices to.
And African farmers want more
Yes.
value for their hard work.
Yes,
when it comes to cocoa.
The Ivorians and the Ghanaians have come together to form some sort of cartel, basically to put a premium of $400 on every metric
bag.
ton.
Every metric ton.
So, and that could be, it's a double-edged sword. I mean, it could cause prices to rise. The prices rise as an incentive for production. People produce more, which in turn causes prices to plummet even further. So it remains to be seen how that plays out in the market. For the time being, prices are just around 2,500 metric tons.
Interesting. Okay, let's leave it there for today. Let's check how this. Maybe you'll be here before next week. Let's find out what happens to prices before we go for the Christmas holiday. Thank you so much. Nasike Nwajide, a research analyst and a member of the economic think tank at Financial Derivatives Company.